Hopefully you guys see that, underwriting is not some chat GPT AI thing that we plug stuff into. They're actually human beings that want to make these loans work. So thank you, Michelle, for coming out here from Colorado. Really appreciate that. So we're going to talk about two things, and I felt like we had some people planted because we're going to touch on down payment assistance, which she asked about, and the loan level price adjustments that are in the news right now. But first thing is the down payment assistance. So as Jeff mentioned, Fairway perennially is the top lender in the state for North Carolina housing loans, the down payment assistance loans. And the people you see up here, the people Jeff introduced, when a customer goes to the North Carolina Housing website and types in, I want more information, find me a lender, they usually do it by zip code. Guaranteed top three, you're going to see at least one Fairway person. Sometimes all three will be Fairway people. And that's because we do the most of them. So we know about these things. Fairway is delegated to underwrite these things. So unlike a USDA loan where you got to package it up and send it off to them, we're delegated to underwrite them. They do have to review the income for this particular program we're going to talk about, but pretty much we know early in the process that it's going to work. So these two guys right here, I'm going to play the naive person and ask some questions so that they can kind of fill in some blanks for you. So the first thing, and we're talking about $15,000. So up until April 3rd, there was $8,000 down payment assistance. They just increased that to $15,000 down payment assistance. So generally, for this type of buyer, the price range you're going to look in, that's going to cover all of the down payment and most of the closing costs, which we all know is important now because we're kind of getting back into a market where you can't ask seller to pay concessions generally. So the more we can get the buyer that he doesn't have to come out of pocket for, the better, because that's generally the biggest thing a first-time home buyer has to overcome is money out of pocket because they're not selling a house and walking with a bunch of equity. So, so let's go through some of the bullet points here. So who is eligible for $15,000 down payment? So I thought North Carolina Housing, NCHFA, I thought they were all FHA loans. So what do you mean they got to be applying for any of these type products? I thought it was all, I thought you could only do FHA.
No, not at all. Even though it sounds like FHA, it's HFA, but that's a fallacy. Everybody thinks it's only an FHA loan. It's any type of loan, conventional, USDA, VA, or FHA. So we can make that choice on which makes the most sense for that borrower, but we get the $15,000.
Why would you need 15 in USDA 100% financing, and I think VA is 100% financing too? Why would you need $15,000? That's
correct. But what happens if we get the $15,000, then we can put some of that money towards the down payment then. So we can actually have, if we have a $200,000 VA purchase, maybe we have a $190,000 VA loan amount. So it makes their payment better because we're putting some towards the loan.
Yeah, can also decrease their funding fee.
That's correct.
If they get down there. All right, so must be a first-time home buyer. I've got somebody, they owned a home, I think 10 years ago, they got divorced and she's been renting. Would she qualify? What does it mean by first-time home buyer, Brian Floyd?
Thank you for asking, Bruce. And you guys stand close for the Zoom mic. I'm not wearing a wire. I have a code. We'll do that in the streets I come from.
We also have our Braille person, so that's good.
So first-time home buyer is defined in mortgage speak. It's going to be ownership interest in a primary residence in the last 3 years. So your buyer that owned 10 years ago through marriage and is now divorced and has not had ownership interest in that house or had it as a primary residence in the last 3 years would be considered a first-time home buyer.
Okay, fantastic. And what about this pre-purchase education? Do they got to go sit in a classroom for an entire Saturday and pay $500? And do they have to do that before I can even show them houses, Terry Weitzel?
Not at all.
Huh? Yeah.
No, so the pre-purchase education is online course. It does take a little bit of time and there are some hard questions, so it's something they have to pay attention to. I don't think there's a cost to it anymore, is it? It used to be, but I don't think there's a cost anymore.
I know there's not to the buyer. We may eat the cost, but we don't pass it on to the buyer if there is one. So, and it is actually very good information that home buyers should know. So it's a good program.
Especially a young first-time home buyer, like a true first-time home buyer should definitely take it anyways.
Yeah. And it talks about citizens, permanent legal residents, Can you touch on that? And I know Michelle touched on it, and she could maybe answer this. Can somebody with a work visa qualify? Can somebody with a permanent resident alien card qualify?
Yeah, Terry, can they?
We've got Michelle right
Follow
here.
Fannie and Freddie guidelines on these, or FHA guidelines.
That's right. There's different qualifications as far as citizenship goes. You do not have to be a citizen, but you do have to be here legally. So what we'll do is we'll get a copy of, any kind of documentation that we need. And a lot of times I'll send it to Michelle or Carl and say, hey, does this work? So when you look at it though, they do not have to be a citizen, but let them get us the documentation we need to see if it works. There's different requirements for the $15,000 versus the regular down payment assistance. So if they don't qualify for 15, maybe they can do regular. So we can look at it.
And to follow up on that too, so very similar to what Michelle was talking about earlier, it all goes back to what the expected continuance of them staying here is. If we can reasonably expect that they're not going to be told to leave in the next 6 months, then we can do the deal. But we have to take a look at that. We have to verify what their status is and what their outlook is.
Yeah, and basically what Brian said before and Terry started with, it's the program guidelines. Whatever VA requires, whatever conventional requires, whatever FHA requires is general. The only overlays are on kind of how they look at income sometimes, but in general for all these type of questions, it's basic program guidelines.
So back to the first question, it's just a conventional loan, it's just an FHA loan, it's just a VA loan. There's nothing to be afraid of here as far as that goes for you.
All right. So how is this structured? Is it a grant that I don't have to pay back? What is this $15,000?
It is not a grant. We're not to use that term.
All right.
Grant means they're giving you money and there's no deal attached to it at all. So what it is it's technically a silent second subordinate lien, which means you're going to get a $15,000, or in the case of a 3% DPA, 3% of the purchase or of the loan amount as a second loan per se, but it's 0 interest, 0 payment. It's only set up as a loan for the purpose of making sure that the people who are intended to use this house or to use these programs are using them, and they're using them how they're intended to be used. The idea of these is to generate home ownership and first-time home buyers, not to get home flippers, not to have brain surgeons buying their mansions or islands in Lake Norman or whatever is for sale right now. But it's to make sure, so they're set up so that you buy a house and they want you to stay in it to maximize the benefit. The next question, I don't know if this is on there, but the next question I get immediately after that from folks is, well, what happens if they leave early, right? So are they going to be penalized? Are they going to have to pay $15,000 that they wouldn't have to pay? So it being a silent second, imagine a $100,000 purchase, and you got a $15,000 down payment assistance loan. So your loan is $85,000, and then you have a silent second for $15,000 that you're not making payments on, you're not making interest. It's just sitting there in case you sell the house too soon, or in case you flip the house, or in case you get moved for work. Stuff happens. You're married, you move for work or whatever. These things happen. We know that. So that loan will be paid back. It's as if you borrowed $100,000. After 10 years, they start to forgive it 20% per year for 5 years. So to maximize the benefit, to truly get that money, I don't think you got to be there 15 full years. And all it is they're basically giving you equity in the house for living in the house. So.
And that includes refinancing. If you refinance, you have to pay it back at that time. So we had a lot of situations during COVID with that we had done these loans, and they were probably $8,000, but we did them, say, in 2017, 18, 19. Homes appreciated so much. We refinanced a lot of borrowers during COVID, and were able to roll that second in, and they still had 20% equity. So, if things keep appreciating, eventually, they're going to build the equity to cover it. So, what do you want to say?
Deferred is the key word. So the way I explain it to my buyers is the down payment's deferred. You can use the state money, the $15,000, or you can bring your own money. A month ago, when the program went to $15,000, the regular conventional rate was probably something like 7.25. Okay, the rate initially for the 15K was 6.5%. So you actually got a worse rate to bring your own money for the down payment than you did if you qualified for the state money and you could get their 6.5%. And we had buyers that would say, but I don't want to pay back the $15,000. Okay, well then here's the way you need to look at it. It's deferred. If you refinance the house or you sell the house in the first 15 years, a portion or all of it's gonna be paid back. Most people that take this loan are probably gonna carry it probably 1 to 3 years. First time home buyers, what do? They buy a house, they live in it a couple of years, they sell it, they move up, okay? If you put the money into the house of your own money and you get the worst rate for 3 years, or you could have taken the $15,000 from the state, gotten the better rate, and let's say you sold it in 2 years, all right? There's a chance that the house would appreciate enough in that time frame that when you sold it, you didn't have to bring the 15. You're still sitting there holding it. So that's the way I explained it to them. It's deferred. You might, if you want to bring it now, bring it now. You're going to get a worse rate. If you don't, and you use the state money, maybe you bring it later, but there's factors that can play into that will determine whether you do or not.
So in other words, going back to that example, the $100,000 house, since we run into a lot of those, and right, you guys sell $100,000. And the $15,000, you're borrowing $100,000 and paying on $85,000 is a way to think about it, people. And this is designed so that it's not a gotcha to. You moved in 14 years, that's a $15,000 penalty for you to the government. You're not going to pay money to sell your house in pretty much any circumstance.
All right, what if, a couple questions on this. Number one, you mentioned, using it for down payment. So if I buy a $200,000 house, I've got to borrow $185 and use all of this for down payment?
No, the down payment for the conventional loan's 3%, FHA's 3.5%, and as Bruce said, USDA and VA's 0 down payment. So we structure it how we need to. There are times when some of that $15,000, maybe I can put 5% down on a conventional loan, depending on the price point, and I can get them a little better payment because I get a little cheaper PMI. But it all boils down to how the deal is structured. If you're able to get $7,500 in seller paid closing cost, I'm going to put more of the 15 towards the down payment. That gets their payment lower.
And just one quick question, because I know we're running out on time. So it does say, and I don't think you touched on this. If you did, I apologize. But if the buyer no longer occupies the property as their primary residence, so if I live there for 5 years, I can afford to buy another home, and I want to turn this into a rental property, do I have to repay the money? Somebody's looking kind of skeptical over there.
I knew you were going to ask me that question.
Yeah, Terry, what's the situation there?
So I think technically, yes, you probably have to refinance it.
Yes, question.
She's still here, by the way.
What's that? Yep, we're going to hit on that. Yep. So anyway, all right.
One
So
more point to push on that too. What if you have a down? Terry mentioned a point where the conventional rate was like 7.25%, and the 15K rate was 6.5%. And somebody's saying, yeah, but I've got a down payment. I want to put a down payment. Can they put a down payment with a 15K also? Yes, they can. They can bring a down payment and get a 15,000. So if it's a better deal, it's a better deal. All right, and they can still take it, and still do what they want to do. So they can get their loan amount down even lower by using that program.
all right.
So basically the way I handle that last line, if you come up to me and say, I'm going to live here 6 months and then I'm going to, buy another house and I'm making this around.
Don't do it.
I'm not pushing you towards the 15K for that.
Yep.
You have to use common sense with everything in the line of work we're in, and that's one of those times.
Yeah. Perfect answer. All right. So some quick key highlights. So max sales price limit is $385. This is unlike a lot of programs. That is not loan amount. So if they found something for $390, they couldn't do it unless they were able to negotiate the price down. Because it's sales price limit, so it's not loan amount. That's unlike, like I said, most every program. Income varies by county and number of occupants. We're going to look, the next slide, we're going to break down the local counties, so you'll see that. Credit score minimum of 640. Do you want to touch on the manufactured home? I mean, just hit it real quick, because really...
It's just basically 660 if you're going to purchase a brand new manufacturer. They will not finance existing manufacturers with this program.
Yep.
Hey, also on the 385 sales price limit, that is for the 15,000. So when it comes to North Carolina Housing Finance Agency, there's really you need to think about 2 pillars of programs. You have the 15K, and then you have the regular DPA, where you can get like 3% DPA and all that stuff. 15K, these are the guidelines we're going over now. Regular DPA is a little bit different, but if you qualify for 15, you qualify for regular. But they actually, you know, there's no 385 price limit on regular.
Yep.
So maybe find one that's 390. All right, 15K might be out, but they do have DPA possibilities.
Yeah, I'm doing one right now. Terry, I'm gonna let you hit on these next two. Max debt to income is 45, no exceptions, and the AUS approved eligible. So you wanna kind of talk about what that means to the buyer?
Yeah, so 45%, they take all of the buyer's debt, including the new monthly house payment, divided by the gross monthly income. That number has to be 45% or less. There's no exception. So if it's 45.01, we gotta get cheaper insurance or something.
That's
to
when
get
we
it
call
under that.
Sean's team back there and get cheaper insurance and get it down. So.
Yep. Now one thing with the debt to income, and one of the issues people always have questions about is, I just started my job, I get overtime income, I've only earned it 6 months, okay? I should be able to use that overtime to help me purchase a house. Well, no, because we don't have the history that they need for the variable income, so we can't use it to qualify you for the 45% to get you under that. But they will hit you for that income in being under the income limit for NC housing. So you could not, qualify on the income limit because they're using your overtime, but we can't use it to help you qualify for the payment.
That wasn't scripted, by the way, I just nailed that.
So it's confusing, but it's all in. Is it usable income to qualify for the loan? Hopefully it is. If it's not and the time frame's not there, they're still gonna count every piece of income you've earned towards the income limit.
You have two kinds of income. You have qualifying income, which is what we've talked about this whole day, and you have compliance income, which is where NCHFA is trying to bust you for being over. So they'll take the worst case on your overtime. They'll do the opposite of what we're qualifying you on to try to put you over.
They'll
So
say you have the
it's two
potential to
different
make
things
this
you need to look
much.
at up front.
Yeah. And again, they're trying to reserve this money for people that need it, but sometimes they go a little bit overboard. The AUS, talk about that, because having subordinate financing is an added risk factor, correct? So we'll get a loan that is approved conventional, and you guys know sometimes conventional is important over FHA, and they're fine if they can come up with their own down payment, but when you call it subordinate financing, in other words, they didn't have the ability to save for it, it's an added risk factor, so sometimes it won't approve. So it is a little bit more sensitive.
And in those situations, when we run it through the AUS program, we'll get a refer, and that means it's a manual underwrite. NC Housing won't allow manual underwrite, so we have to tweak it to where we can get that approval. Maybe we can work out and show a few more months reserves, or maybe we can pay off something and get that DTI down a little bit to get the approval.
Or flip it
from a
FHA.
refer, or flip it to FHA.
Yep.
And FHA right now, I would say probably 40% of my deals are going FHA, whereas a year and a half ago, maybe 5% did. FHA is a very viable option right now. Sellers are willing to give more ground. Sellers are paying closing costs, so they're making repairs if they have to. The change, 2 months ago with the MI dropping, you actually have cheaper mortgage insurance now on an FHA loan than you do on a conventional loan if you got a 720 credit score. So FHA is something that you need to look at for buyers because it may be a cheaper payment. They can get more seller concessions. So there's reasons to use it, and it's easier to get an approval in a lot of situations, FHA over conventional, especially if you have thin credit. You're young and you don't have a lot of credit history, FHA may be the way to go.
And real estate agents, you probably work with sellers too. Talk to your sellers about that when they're getting FHA offers.
Yeah.
There's other reasons besides all this, their only option. So it's not something to be afraid of.
All right, we're on the clock. The underwriter just said we're on the clock, so we're gonna go to the next screen and look at, or go back to that one because this is important. That one right there, the income. Yep, there you go. All right, so these are the income limits for our local counties, and I believe Rowan is the same as the top, correct?
Yeah, I think you're right. I think so.
So you want to just hit on that real quick, what the household makeup means, Terry?
Yeah, so it looks at borrowers that are going to be on title. So if you have You know, boyfriend and girlfriend, I think somebody asked the question a bit ago, boyfriend and girlfriend are in the house, and you're using boyfriend on the loan, he's the only one that's gonna be on title, then his income is what household income is. If it's a married couple, then it's both borrowers' income, even if only the husband is on the loan. So you have to look at what the makeup of the household is. There's different scenarios, but that's what they're looking at. That is gross. Yep.
And that's going back to that compliance versus qualifying income. So compliance is where we're going into next. Where if they have only 6 months of overtime we're not qualifying them with, that is going towards that. And it will.
Yep. All right, and then the 3 people obviously is if you have a child or more, but it caps it. You just got to be 3 to jump up to that 110 allowable household income. Child in utero does not count. We found that out a couple of years ago.
But if you get a call from the delivery room, clear to close shall follow.
We had to wait a month till the child was born. Yeah, so
Exactly that.
very funny. All right, next slide is
Real quick, Rowan, is 92, not 96.
92 for the 2-person.
2 and 106 for the
Okay. All right, that's Graham Pruitt, everybody. Let's give him a hand.
Coach Graham Pruitt.
Coach Graham Pruitt.
Mount Pleasant basketball Tigers.
That's right. Undefeated so far. All right, so we talked, Brian hit on this, includes only those who are on title in the home as far as the income, but obviously the kids put you over the top to get to that next level, and must count spouse's income, so that's where we get caught up sometimes. A lot of programs, and some of the North Carolina housing programs, it's only what we call 1003 or applicant income. For this program, it's household income as we've defined here. So if somebody has bad credit and they're not on the loan, but they work and it puts them over that income limit, then they can't qualify for the 15K. We do have some exceptions for income that we don't have to count. Most of these are kind of, well, foster care, that's a continual income that we don't have to count as far as what the maximum they can make. Inheritance, obviously that's a one-time deal. Sporadic or regular gifts, one-time deal, sign-on bonus, all those things are pretty much one-time hits, so we don't have to count those. All right. Any questions on down payment assistance? Any of these folks that Jeff introduced can answer any of these questions, or if you need clarification, but any quick questions off the bat from anybody? Yes.
I saw in the last slide that you could use the down payment assistance programs combined. So you could use the 8,000 and the 15,000?
The 8 is now gone. The 8 is the 15 now.
Okay.
But you can use it with other programs like House Charlotte. There's some programs in the Charlotte area that you can combine it with.
So it's NCHFA and other, you know, so you can't do like multiple NCHFA schools, if that makes sense. But there are, you know, like I said, House Charlotte and some.
The main point that I would look at if I were you guys is just make sure your clients know that this is out there, because there's a lot of lenders that don't present it. It's because they don't do it. Okay, I get a lot of calls from people that, you know, gosh, I didn't know it was available. My last lender didn't even show it to me. And it makes sense. And yes, credit union, that's probably my number 1 competitor right now is the credit union. It's a great program. I bank there, 5-year arm, 100%, no PMI. All right, look. I got a credit union loan officer that emailed me 3 weeks ago. Man, you trying to get on my Christmas list? You know, I'd like to be your business development person for some of these things. But the 15 allows us to compete with that program because the credit union gives you $2,000 if you're a first-time home buyer, but you know what? They increased the loan amount that too to give you that. We're giving you $15,000 and you can cover just about every cost you have on the loan depending on the purchase price.
All right, this is a hot topic, and I've got 2 questions on it during the break. Loan level price adjustments. If you guys watch, well, you didn't watch Tucker Carlson because he's not on TV anymore, but or Don Lemon for that matter. So the question is there really a new unfair mortgage tax on those with high credit? And you know the media's grabbed a hold of this. Yes, some changes have been made. So this is what's called loan level price adjustments, or LLPA. So conventional loans, which Michelle talked about, are invested, Fannie Mae and Freddie Mac are the investors in conventional loans. They've always had tiered pricing or loan level price adjustments. So, you know, mortgage is a risk-based product. If you don't put 20% down, you got to carry PMI. If your credit scores are lower, you're a higher risk than if your credit scores are higher, because you've demonstrated you're not as likely to repay your debts as you are if your credit scores are higher. whether credit scoring is fair or not, that's how it's done. So these loan level price adjustments have always been there. They've been very severe on the bottom. So people with lower credit, they've really hit them hard. So you may have somebody with a 640 credit. Their rate, it's really in pricing, but their rate might be 3/8 to a half a point higher than someone with an 800 credit score. Is that fair? Well, if I'm an investor, yeah, it's fair because I'm taking a risk lending you money. So, the government, which has authority over Fannie and Freddie, said, hey, let's bring more people into the home buying process, because that's how you create wealth in this country. So we're going to kind of flatten out some of these adjustments. So go to the next slide, and this is what is causing all the angst. So anything green is an improvement. Anything red is a negative impact to those folks that fall into that class. So what do you see here? Down here on the left-hand side.
Real quick though, this is compared to what it was. This is not.
These are the
how
changes, yes.
Approaching current price. This is like how they changed it from how the LLPAs work. So
Yeah, so it's
no
not,
additional fee or anything.
it's not, if you look at a, 75
Really
to
important.
80% credit score of 660, you're saying, well, they're getting a 7/8 improvement in their pricing over somebody that's a 760 credit score. So they're getting charged a point. So you're saying, well, the guy with the worst credit's getting a point better towards his interest rate. And that's not rate, but that's the cost to get the rate. Those are just adjustments. Those are what the changes were to kind of flatten out the, if you call it, disparity. Did they penalize people with higher credit? Absolutely. I mean, they made it harder for somebody that's managed their credit better, or more expensive for them to get the same rate that they got before these changes went into effect. And by the way, they went into effect 2 months ago. The loans are sold as of May 3rd. The loans that are sold to Fannie and Freddie have to have this pricing structure in there. So we've been dealing with
when you see
this.
May 1st, these changes don't take effect next week.
They're already in there.
These already took place 30 to 60 days ago. Why?
Because they...
That's a largely political
I mean,
question.
I know why, but this lady's got a lot more education than I do. So.
Affordable housing.
Yeah.
They want to encourage people who have lower credit scores to be able to get into a house and be able to help them more. So this actually helps them. So is it penalizing people with better credit scores? Yes, to a point, but it's helping people who couldn't afford to get into a house previously be able to get into a house.
So somebody who can take care of a credit score will take care of the house.
No, I mean, here's the deal. You still,
You're still paying more if you
yeah,
have lower credit.
you still, these again are just the changes. So the disparity was enormous. Like the one I point out, they were probably paying 2.25 points, and the guy at 760 was paying like 3/8 of a point. So they've improved that by a point net, but the guy with the 760 is still getting a much better rate than the guy with a 640. So it's still, bottom line,
Keep paying your bills, please.
keep paying your bills.
Not
And
gonna better your situation
Yeah.
by taking
high,
your car payment.
here's what you need to know. Higher credit still gets the best pricing and the best programs. And we didn't touch on, if you don't put 20%
They're working
down,
on it.
you have
add
PMI,
it
and
last
that's
week.
also risk-based. So lower credit scores pay a lot more for the PMI. So
So this might surprise you here. It's actually super complicated. My job is very complicated, which is why I'm not a mobile app up here talking to you, and I have a job. So LLPAs get it loan level price adjustment. They get adjusted all the time. You might be surprised to hear that before this, 20% down did not get you a better LLPA. You had a better LLPA at maybe 5 or 10. Why? Because, well, you've got the backing of PMI, so you're a safer risk to the investor at that point.
Yep.
So a lot of things go into it. If I can encourage you one thing, is please don't get your mortgage news from TikTok, especially if it's like a 19-year-old pointing to subtitles. These are the kinds of things you're hearing and the kinds of things you're seeing are usually the kinds of things people who don't know what they're talking about are saying. So be real careful with that. Our TikToks are very good.
Yeah.
But,
mortgage cat.
yeah. Sorry, I'm not on TikTok. I'm not 15.
So that was pretty quick running through that, but I think the thing you need to walk away with is you still want to have the higher credit. One thing, let me just point this out, the tier at the top has been added to, I guess. It used to be anybody above 740 got the best pricing as far as their interest rate. Now they've added 2 more tiers in 20-point increments. That's important because we have the ability to look at someone's credit that might be good. It might be a 739, which is really good, but we can tell them some easy things to do to get it up to 760 or 780 and improve their pricing even more. Most lenders can't do that. We've got credit simulators we can run. I won a deal today because I was able to talk a guy through that. The lender we went to online did not even mention that. So just know that. And the earlier we talk to people, the better, so we can work through all this stuff. So.